Investing in oil stocks for passive income. One of the most important commodities in the world economy is oil. This fossil fuel is utilized to produce energy, petroleum products, and a variety of consumer items. As a result, the oil market is a profitable investment that thrives despite inflation, a recession, and other economic uncertainties. But navigating the oil market may be challenging. Knowing how to invest in oil is more important than ever for investors, especially in light of the current epidemic and the Russian invasion of Ukraine. Why buy oil? Oil, usually referred to as crude oil, is the heavy, viscous, and dark fossil fuel that is drawn from an oil well. Oil is one of the most important commodities in the world economy, and investing in it can be quite profitable. The following are some benefits of investing in oil. Oil is a great inflation hedge since the price of crude oil rises along with inflation. In reality, an increase in the price of oil has a significant impact on global inflation rates. This is because the fluctuating price of oil influences the cost of everything, including consumer items, petroleum products, and gas prices. So, an oil investment can safeguard your portfolio when inflation depletes your fixed income. Diversity of holdings. Your investment portfolio shouldn't be dependent on a single sort of investment. You'll need a backup strategy if all of your investments are in equities and the stock market crashes. Oil is a strong portfolio diversifier since it still offers gains even if one of your investments declines in value. Stream of unearned income. You can generate a steady stream of income by investing in crude oil futures, oil equities, energy stocks, mutual funds, or exchange-traded funds, ETFs. As a result, after investing in an oil mutual fund, you may relax as your money grows to supplement your fixed income. High returns. There's risk involved because the oil market can be extremely unpredictable. Nonetheless, this volatility has the potential to yield large profits. For instance, you would have spent roughly $60 if you had purchased a barrel of crude oil in August 2021. You could have sold that barrel for $119 in March 2022, a 98% increase. Let's now examine various strategies for investing in oil. How to make oil investments. Beginner investors don't have to worry about keeping massive barrels of crude oil in their backyards because there are numerous options to invest in oil. Some of the various oil investments include the following: futures and AMP, options on oil. ETFs and AMP, ETNs for oil. Mutual funds for oil. Stocks of oil. 1. Futures and AMP, options on oil. The principal market for trading crude oil is the futures market, and a crude oil futures contract is more sophisticated than merely purchasing oil equities or ETFs. Purchasing a crude oil future binds you to make a future purchase of 1,000 barrels of crude oil at a predetermined price. For instance, you could purchase a crude oil futures contract that would entitle you to purchase crude oil at a future price of $100 per barrel. You will be able to purchase crude oil at a reduced price if the price rises and oil starts to trade for $200 per barrel on the futures market. After that, you can sell your future contract to a bidder for a profit and a cash payout. Or, you might let your contract expire and get your oil for $100. Futures trading is the act of selling a futures contract before it expires and paying the transaction in cash. Yet, there is another option if you don't want to worry about getting crude oil barrels. Oil options are agreements that provide you the choice, but not the duty, to purchase oil barrels at a certain price on a future date. 2. Oil ETFs and AMP, ETNs. You can invest in a fund that contains oil equities, barrels, or crude oil futures contracts using oil exchange-traded funds, ETFs. Trading in oil ETFs takes place on significant stock exchanges, and investors think that doing so is simpler than purchasing a crude oil futures contract. The fact that you are not needed to have any crude oil drums in your garden is another advantage of ETFs. You can invest in the following oil ETFs: the American Oil Fund, the DB Oil Fund of Investco, the Dow Jones U.S. Oil and AMP, Gas Exploration and AMP, Production Index Fund by iShares. Additionally, astute investors have the choice to purchase exchange-traded notes, ETNs. ETNs resemble bonds more. They are an institution-issued, unsecured type of debt note. Therefore your investment would lose money if you bought oil ETNs from an oil drilling business and filed for bankruptcy. When you invest in oil ETNs, unlike oil ETFs, you don't own the equities or futures contracts that they are based on. Instead, you are compensated with the returns that these assets provide. 3. Oil mutual funds. Mutual funds for oil are collections of oil stocks that you can purchase all at once. The diversification offered by an oil mutual fund investment is superior to that of a portfolio made up entirely of equities and bonds, but it falls short of that offered by a broad index fund. An oil fund would perform worse than a more diversified fund if the oil sector collapsed. Shares in oil firms are known as oil stocks. Crude oil from an underground oil well is either refined or extracted by oil corporations. Researching which energy stock and oil firms to choose is crucial because there are numerous oil companies listed on the stock market. Here are 5 outstanding oil stocks to consider. The largest oil producer in the United States is ExxonMobil. The ExxonMobil Oil Corporation pays a 4.1% dividend and has a 35% connection to the price of crude oil. Occidental Petroleum. According to the 2021 Fortune 500, Occidental Petroleum was ranked 183rd. They are an American corporation that explores petroleum and hydrocarbons in Chile, Canada, the Middle East, and the United States. APA, previously known as Apache. APA is a significant natural gas and oil producer in the United States. The biggest correlation of any investment suggested by Bank of America is found in the shares of APA, which have a 47% relationship with WTI, West Texas Intermediate, crude oil prices. Baker Hughes. This large oil corporation has a 44% correlation to the price of WTI crude oil and supplies technology and equipment to the energy industry. Chevron. One of the biggest oil firms in the United States, Chevron's energy stock has a 44% correlation with the price of crude oil. Negative effects of oil investment. Volatility is the biggest drawback of investing in oil. Like most commodities, oil is significantly impacted by factors such as global demand, supply, and technology. Worldwide demand. When demand for oil declines, the price of oil also declines since less money is being spent on it. Also, the number of oil reserves is limited. Global supply. As oil supply declines, prices rise. Using the present Russian invasion of Ukraine as an example, boycotts of Russian oil have spread throughout the world. Crude oil prices have increased as a result of the reduction in supply, and are now happily trading above $100 a barrel. Yet after the fighting is over, analysts predict a significant drop in crude oil prices. Technology. Developing nations are turning more and more to renewable energy sources. Oil demand will decline as alternative energy technology advances. The oil market also exhibits the same peaks and valleys as the larger stock market. As a result, oil is expected to be impacted by increasing market volatility in one sector of the global stock exchange. Let's now examine a different investment that offers all the advantages of oil without any of the disadvantages. Good wine. A fantastic alternative investment. Recession. Fine wine. Fine wine is an alternative investment that offers significant returns, much like oil. For instance, during the past 15 years, wine has done 5.1% better than the S&P Wink with tongue sticking out 500, which contains 61 significant oil companies. Fine wine is less flammable than oil, though. The longer you hold on to your wine investment, the less volatile it gets as wine bottles become rarer with time. Also, wine costs rise in tandem with inflation, making it a great inflation hedge. Yet, because oil is needed for transportation and the production of glass bottles, the wine business exhibits comparable tendencies to the oil market. Therefore, wine is affected by a fall in the oil market. Finding a reliable broker, however, can be challenging, and buying the bottles yourself takes time because it takes extensive research to decide when to sell. Also, it costs money to provide your wines with temperature and humidity controlled storage spaces. Fortunately, the simplest method to acquire, authenticate, and maintain a portfolio of investment-grade wines is through a reputable wine investing platform like Vinovest. Even better, they'll keep your wines in their temperature-controlled bonded warehouses for you. How was the video? Did you enjoy it? Post your feedback in our comment section below. And subscribe to our YouTube channel for more updates.